Every time you need money from your business, you trigger a tax bill. Every time. And you have been doing it so long, you think that is how it is supposed to work. It's not. There's a strategy the wealthiest families in this country have used for decades to access their money without handing the IRS a cut. It is called buy, borrow, die, and it is not a loophole. It is how the tax code was designed. Hi, I'm Mia, certified CPA. Today I'm breaking down exactly how buy, borrow, die works, who it is actually for, and the mistakes that makes people try it the wrong way. But first, I need to show you why you're stuck in the cycle that the wealthiest people figured out how to escape a long time ago. Picture this. All-you-can-eat buffet. You are starving. Biggest plate they have. Steak, shrimp, all the good stuff. You've earned this. Right before you sit down, there's Uncle Sam standing at the end of the line. He reaches over and takes a chunk right off your plate. Does not warn you, does not ask, just takes it. And it gets worse the more you pile on. Seconds, bigger cuts. Premium sections, even bigger. So you accept it. Must be how the buffet works. Everybody deals with Uncle Sam. Look at your business right now. Revenue climbs and Uncle Sam's cut climbs right alongside it. At a certain point, it stops feeling like a tax bill and it starts feeling like a punishment. Then there's a timing. Cash finally comes in. You take a breath. Payroll is due. A vendor invoice lands. The work truck needs a new transmission. And right in the middle of all that, tax time shows up. Now you're doing math in your head. Do I hire? Do I buy that truck? Can I reinvest this or does the IRS need it? There's a different line at this buffet. A different plate, a way to eat where Uncle Sam is nowhere near your shoulder. Your tax bill keeps climbing and it has nothing to do with how hard you work. It has everything to do with one decision you keep making on autopilot every time money hits your account. The roofer. A client of mine runs a roofing company. 12 years in business, good reputation, crossed $2 million in revenue and thought he was finally winning. On paper, he was crushing it. But every tax season he was scrambling, up at 2 in the morning, staring at his bank account, trying to figure out how he owes as much when it feels like he just paid. He told me, I made more money this year than I have ever made in my life and I never felt so broke. Every time a big payment came in, he spent it like a business owner who thought he knew the rules. Bought a building thinking it was a write-off, took a family to Cancun and called it a business trip. The building? Wrong kind of deduction. The trip? Not even closed. Half the expenses he assumed were write-offs were just money walking out the door with nothing to show for it come April. His bookkeeper missed it, his CPA never mentioned it, then tax time rolls around and the bill lands like a gut punch. $50, $60, sometimes $80,000 due in a week. This is the guy who would never let a customer live in a house with a leaking roof and just hand them a bucket every time it rains. He would fix the roof every time, but he was doing the exact opposite with his own money. Every tax season was another bucket, another scramble, another patch on a problem that never went away. He did not need another bucket, he needed someone to fix the roof. We restructured how he paid himself, built the system where he knew that was owed before it was due, then layered in entity restructuring, retirement vehicles, equipment write-offs, time to when they actually made sense. Within 1 year, over $120,000 in tax savings. Legally, changed nothing about how hard he worked. He told me, for the first time in 12 years, I actually feel like I own this business instead of it owing me. And that is what we do at Havenstone. If that story feels like yours, link is in the description. So why does this keep happening? To him, to my other clients, probably to you right now. The only way you know how to access your own money has a tax bill sitting on the other side. Write down, pause this video if you need to. The only way I currently access money is through something taxable. If that is true, you're not broken. You're just running the default path because nobody showed you another one existed. The framework that changes this is called buy, borrow, die. And I know what you're thinking. Mia, that sounds like something billionaires do on a yacht. Good. First myth to break. One of my clients, electrical contractor, $3 million a year, owns his building, a rental property, and a brokerage account he barely looks at. When I brought up tax strategy, he stopped me. Mia, I pull wires for a living. This stuff is for rich people. I said, you own a business worth real money, 2 properties, and an investment account. You are the rich people. You just never felt like it because nobody ever treated you like it. We took the equity in his building and opened a line of credits against it. Cash in his hands, nothing reported as income. Liquidity from something that had been sitting there 9 years collecting dust. He said, why did nobody tell me this before? Now let me show you how that works. 3 steps. Step 1, buy. Own assets that grow. That is it. The whole strategy falls apart if you skip this. The best accountant on the planet cannot save you if you do not own something that appreciates. And you probably already do. The building you operate out of, bought it for $350, 8 years later worth $700. Time did that. That rental property, tenants paying down your mortgage while the value climbs, equity building in the background every single month. A business, the one that you built with your own hands, revenue growing, client base growing, real equity. Most owners never think about it that way. Step 1 is not go find something new. It is recognizing what you have already and stop selling it every time you need cash. The last part is where everyone gets tripped up, which brings us to step 2. Quick check. Before step 2, pause for a second. Think about the last time you needed a large amount of cash for your business. Where did it come from? Did you sell something? Pull a distribution? Drain an account? If the answer to any of those is yes, you triggered a taxable event. And step 2 is how to stop doing that. I put together a free buy, borrow, die cheat sheet that maps out how this strategy applies at different income levels. Link in the description. Grab it. Step 2, borrow. This is where the strategy gets its teeth. Borrow against the asset to access cash. The IRS does not count borrowed money as income. Nothing sold. The compounding keeps running. All you did was use what you already own as collateral. Most people have never taught this. They think the only way to use an asset is to sell it. Borrowing is how wealthy families use assets without destroying them. So let me show you what happens when you get this wrong. A client of mine runs a landscaping company, $4 million a year. He needed $600,000 to buy out a partner. Needed it fast. So he sold a commercial property he had owned for 7 years. Between capital gains, depreciation, recapture, and state taxes, he lost almost $200,000 to the IRS. $200,000 gone. 7 years of ownership wiped out in one transaction. And that property, worth almost double today. The equity, the cash flow, the appreciation, all of it gone. He sold the golden goose to pay for one meal. If we had worked together at that point, we would have borrowed against the property instead. Line of credit, $600,000. Same buyout gets handled. He walks away still owning the building, still collecting appreciation, and the IRS gets nothing because debt is not income. One path cost him $200,000 and an asset he can never get back. The other costs interest on a loan he pays on his own schedule while the building keeps growing underneath him. One makes you lighter, the other makes you stronger. The truck rule. Ever seen someone buy a truck they cannot afford? Payment looked fine on a good month. Problem is, not every month is a good month. Bad borrowing looks exactly like that. Borrow the max, leave zero room. Everything has to go perfectly just to keep up. Then one thing breaks, and that smart strategy turns into a noose. Smart borrowing is boring. It should feel almost too conservative. Borrow less than you could. Keep 6 months of cash on the side, and before signing anything, ask one question. If my worst month became my every month, can I still make this payment? And if the answer is no, walk away. Step 3, die. This is the part that turns buy, borrow, die from a tax play into a wealth strategy. When you pass away, certain assets receive what is called a step-up in basis. Decades of capital gains tax wiped clean the moment your wealth transfers to your children. Plain English, a family builds a business and a few properties over 30 years. Started at $500,000, now worth $3 million. Sell while alive. The IRS takes $600,000 or $700,000, hold and pass it to the kids. Basis resets. $2.5 million in gains vanishes. Legally, not a loophole. The tax code working how it was written. But most families never get there. There's no trust. There's no estate plan. Something happens and 30 years of building gets undone in 30 days. More than money changes hands. The playbook changes hands. It sounds dark. It is actually the most generous financial move you will ever make. The 4-minute mile. In 1954, Roger Bannister ran a mile under 4 minutes. Every scientist said impossible. He did it anyway. Within 2 years, dozens broke the same barrier. The track did not get shorter. Somebody proved the limit was not real. That is what happens in my office every week. Someone walks in convinced the system is rigged against them. Tax strategies is for billionaires. The rules are the rules. One conversation, the barrier disappears. The taxes are real. The belief that you're stuck never was. If you're still watching right now, most people left a long time ago. If you're still here, that tells me you are not looking for a shortcut. You want to understand how this actually works. That puts you ahead of almost everyone. This last part is for you. I work with a couple I would call Jerry and Elaine, on track to pay $1.9 million in lifetime taxes. Just earning, withdrawing, reacting, paying whatever the bill said each year. We built a multi-year roadmap. That burden dropped by $400,000 $100 and their after-tax income went up. Same people, same effort. The only thing that changed was the strategy. The wealthy do not win the secret loopholes. They win with assets, timing, and the right order of operations. Most people focus on this year's returns. Real strategy looks 5 years ahead. Here's your first step, and it's not go borrow. Get clear. What do I own? And what is my plan to access cash that does not hand the IRS a cut every single time? If you cannot answer that in one sentence, there's no strategy yet. Just hope and react plan. Grab the free buy, borrow, die cheat sheet, link in the description. It maps out how this applies at every income level. Next time you walk into that buffet, you're not going to stand there and let Uncle Sam help himself. You're going to know exactly where the other line is. If you want help building the full plan, this is what Havenstone exists for. Your income, your assets, your family, link in the description. And if someone in your life is a business owner who dreads tax season every single year, send them this video. It might change how they think about money forever. Next video, I'm breaking down the top 10 tax strategies that my highest earning clients use every single year. These are specific moves, the ones most CPAs never bring to the table. Do not miss it. See you in the next one.